In late March this year, Archegos Capital Management, a family office that managed the personal assets of Bill Hwang, saw $100 billion evaporate, with Hwang personally losing $8 billion in 10 days. In this video, we will discuss the reasons behind the implosions of Archegos and the wider implication that it could have. Bill Hwang is famously known as the protege of the hedge fund legend Julian Robertson, who ran the Tiger Hedge Fund. Before running Archegos, Hwang was staked with $1.2 billion by Robertson to start Tiger Asia, a New York-based fund picking Asian stocks. In 2012, Hwang pled guilty on behalf of Tiger Asia Fund and paid $44 million to settle the civil lawsuit of the Chinese insider trading scheme. As a result, Hwang closed the fund and set up Archegos Capital as a family office to avoid facing similar kind of scrutiny. Archegos began with $200 million, but quickly grew to almost $10 billion over 9 years, using borrowed money from banks to leverage returns. The first factor behind Archegos' implosion is the lack of transparency. Family offices are mostly allowed to keep their internal workings secret with few disclosure requirements, unlike hedge funds or pension schemes. Due to this, regulators were left with very few avenues to monitor systematic risks that might lead to a massive sell-off of Archegos Capital Management. The second factor is the overly complex investments. Hwang deployed a financial instrument known as the total return swaps. In exchange for a fee, Hwang bet on the direction of a stock and gained exposure without paying full price, which created 5 times leverage. By 2021, Hwang was leaning on 6 prime broker investment banks for his total return swaps. The banks appeared to conclude that the risk posed by Hwang's character was outweighed by the profitable business for the trading desk that Archegos could bring, with loss of trading in swaps. Due to the nature of the total return swaps, the banks built up hugely long positions in Archegos' portfolio companies. For instance, the banks reported owning 68% of GSX and 29% of Viacom CBS. While Archegos' portfolio swelled from $15 to $20 billion, its total exposure was $100 billion. This leads to the third factor that contributed to the collapse of Archegos, which was the use of excessive leverage. With a portfolio that was levered from 5 to 20 times, it only took a 15 to 20% sell-off to blow out billions worth of positions in Archegos. Viacom CBS was the trigger for Archegos' collapse. From the total return swaps, Hwang had a $10 billion stake in this firm. On March 22nd, Viacom CBS announced an approximately $3 billion share sale. This led to an over 20% sell-off and put huge pressure on Hwang's portfolio. Goldman Sachs and Morgan Stanley exited the trades by selling large blocks of Archegos-linked companies when Viacom CBS declined by 30% on March 25th. Similar sales in Discovery, Farfetch, and other Chinese firms hammered the stocks. In 10 days, Archegos lost $100 billion, with Hwang losing $8 billion personally. The fall of Archegos has commercial implications on 2 areas: the efficiency of risk management from investment banks and regulatory oversight of the interactions between banks and non-banks. First, Archegos incident exposes poor risk management among a number of huge investment banks who were drawn to providing high leverage for speculative bets of a profitable family office, however implausible. Consequently, investment banks like Nomura lost over $2 billion, while Credit Suisse lost over $5 billion. Second, the incident could lead to stronger oversight of family offices and hedge funds in general. After the 2008 crisis, Dodd-Frank also tightened financial regulations. So, in the near future, banks are likely to tighten up the leverage they offer to family offices and other speculative accounts following the Archegos incident. Thank you for watching our videos. If you enjoy further content like this, please don't forget to like, subscribe, and leave a comment down below to let us know your thoughts.